Hello, everyone. Welcome to Business School 101. Warren Buffett, the chairman and CEO of Berkshire Hathaway, is famous for a successful career picking stocks. But he has said, for most people, the best thing to do is to own the S&P 500 index fund. In fact, he's instructed the trustee who will be in charge of his estate to invest 90% of his money into S&P 500 index funds for his widow. So what exactly is the S&P 500? Why is it always recommended by many successful investors in the world? Should college students invest in it? In this video, I'm going to answer those questions for you. The S&P 500, or S&P, is a stock market index composed of shares of 500 large, industry-leading U.S. companies. It is widely followed and often considered a proxy for the overall health of the U.S. stock market. Every quarter, the S&P Investment Committee meets to review which stocks belong in the index based on each company's market size, liquidity, and group representation. Today, 505 stocks constitute the index, since some of the 500 companies have more than one class of shares. Contrary to popular belief, the stocks forming the index are not the 500 biggest U.S. companies, but they are arguably the 500 most important companies. Over $11.2 trillion is invested through the index, with these 505 stocks representing about 80% of the total U.S. stock market's value. As a cap-weighted index, the S&P 500 weighs the stocks by the market capitalization or total market value, which means the larger the company, the greater its influence on the index. To qualify for the index, a company must meet the following criteria. First, it must be headquartered in the U.S. Second, its market cap must be at least $8.2 billion. Third, its shares must be highly liquid. Fourth, at least 50% of its outstanding shares must be available for public trading. Fifth, it must report positive earnings in the most recent quarter. And finally, the sum of its earnings in the previous 4 quarters must be positive. Technically, any company that satisfies the above conditions can be considered for inclusion in the index. However, the ones that actually make it are the ones with the largest market capitalization. In addition, since companies' share prices fluctuate over time, the constituents of the index keep changing. With that in mind, here's a look at the 10 largest companies included in the S&P 500 index as of March 2021. As you can see, the S&P 500 includes the largest American companies in almost every major industry. It sorts publicly traded companies into 11 sectors and 24 industry groups. Order of the 11 sectors based on size is as follows: information technology, financials, healthcare, consumer discretionary, industrials, consumer staples, energy, utilities, real estate, materials, and communication services. Similarly, this order could change over time. Now that we understand what the S&P 500 is and what it's composed of, let's discuss how to invest in the S&P 500 and the pros and cons it has for a college student. Investors can invest in the S&P 500 by purchasing index funds or exchange-traded funds, or ETFs. However, there are 2 major differences between index funds and ETFs. First, ETFs can be traded throughout the day like stocks, whereas index funds can be bought and sold only for the price set at the end of the trading day. Second, in many cases, ETFs will have a lower minimum investment than index funds. Most of the time, all it takes to invest in an ETF is the amount needed to buy a single share, and some brokers, such as Robinhood, even offer fractional shares. But for index funds, brokers often put minimums in place that might be quite a bit higher than a typical share price. Vanguard, for example, has a minimum investment of $3,000 for most of its index funds, while T. Rowe Price has a minimum investment of $2,500. Therefore, due to its flexibility, I believe ETFs should be a better option for college students. In general, there are 3 major advantages with investing in the S&P 500. First, diversified risk. When you invest in the S&P 500 index fund, you become a part owner in all 500 of these companies. More importantly, instead of buying an equal share in each of them, your investment is weighted based on their size. So you buy more of the biggest one and less of the smallest one. For example, the largest company in the S&P 500 today is Apple at almost 7% of the index, and the smallest is Under Armour at about 0.02%. This means if you invested $1,000 in the S&P 500 index fund today, you would get about $70 of Apple stock and about 20 cents worth of Under Armour. Therefore, when you buy S&P 500 index fund, you will be a part owner of the 500 largest and most successful companies in the US, and that means when they profit, you profit. Second, low management fee. One of the best ways to get a higher investment return is to pay fewer fees. Index funds offer diversified holdings and help investors keep more money so their earnings can compound faster. From this perspective, index funds are a great option for any investor and are particularly suitable for smaller individual investors like college students. Compared with an actively managed fund, the S&P 500 index fund normally charges the lowest management fee. For example, the average expense ratio for actively managed mutual funds is between 0.5% and 1%. For passive index funds, the typical ratio is about 0.2%. If you invest in the Vanguard S&P 500 Index ETF, the cost rate is only 0.03%. Third, it has relatively stable long-term growth. The S&P 500 Index originally began in 1926 as the composite index, composed of only 90 stocks. Over long periods, the S&P 500 has continued to go up, despite short-term volatility. According to historical records, the average annual return since the inception of the S&P in 1926 through 2018 is approximately 10% to 11%. The average annual return since adopting 500 stocks into the index in 1957 through 2018 is roughly 8%. So if you invest $10,000 in the S&P 500 in 1957 and stay there for 61 years, you will have $1,093,576, which is more than 100 times your initial investment. However, investing in the S&P 500 is not without its drawbacks. Here are its major limitations. First, long-term growth does not mean no short-term risk. One major factor in annual returns for an investor in the S&P 500 is when they choose to enter the market. For example, the index fund performed very well for an investor who bought between 1996 and 2000, but investors saw a consistent downward trend from 2000 to 2002. Investors who buy during market lows and hold their investment, or sell at market highs, will experience larger returns than investors who buy during market highs, particularly if they then sell during dips. In addition, you should always keep in mind that past performance does not guarantee future results. Second, it only includes large companies and US-based companies. There is no doubt that almost all of the companies listed in the S&P 500 are very successful American companies with dramatic historic performance. However, because S&P 500 companies only include the largest companies based in the US, if you only invest in it, you miss the opportunity to invest for some startups or foreign companies. For example, Google was established in 1998 and went IPO in 2004. Its stock price was $85 at the time. Google was added to the S&P 500 in 2006, and its stock price already climbed to $342. So in 2 years, Google's stock price quadrupled, which is clearly much better than what you could get from the investment in the S&P 500. However, the tricky part is that you need to identify Google's potential early on and be able to invest in it on time. It's easier said than done. Keep in mind that there are tons of stocks out there, but they do not always end up being Google. Third, passive performance. Because both S&P 500 index funds and ETFs are passive management funds, which means they automatically track all companies listed in the S&P index, they do not carry the potential to outpace the market the way that managed funds can. This means that if you invest in the S&P 500, you are surrendering the possibility of a massive gain. The top-performing non-index funds in a given year perform better than the top-performing index funds, and the very best non-index funds can perform far better than an index fund in a year. However, the top-performing non-index funds may vary from year to year, so underperforming years can cancel out the overperforming ones. After explaining these pros and cons for investing in the S&P 500, the final question is, should you invest in it as a college student? My answer is generally yes, but it still depends on your personality, your financial situation, and your investment strategy. If you are a conservative investor who has a relatively low risk tolerance, who targets the long-term growth and has no time or interest to study the stock market and explore the individual stocks, then investing in the S&P 500 should be included in your investment portfolio because it fits your strategy very well. However, if you are an ambitious investor, only interested in extraordinary returns, have the stomach to tolerate the roller coaster ride, and also have time and desire to learn the investment skills, then investing in the S&P 500 might not be a good option for you. Alright, that's all for today's topic. What do you think about it? Will you invest in the S&P 500 index fund? Please leave your thoughts in a comment below. As always, this channel aims to educate college students on matters related to the business world in hopes that you can apply the information to your own lives. I hope that you guys have enjoyed this video, and if you did, make sure to give it a thumbs up. Also, please don't forget to subscribe to the channel and click the notification bell so that you can be the first to know when I upload new content. Thanks for watching, and I'll see you next time.